Ladies and gentlemen, welcome to a new episode of the FinTech Hunting Podcast. We have an incredible guest for you today. She's an industry thought leader, a process and efficiency evangelist, and an M&A expert. Please help me welcome to the show, Julia Brown. Julia, welcome to the show.
Thank you, Michael. It's great to be here.
Oh, it is great to have you. You have a wealth of knowledge and expertise, and especially in today's market, a critical area that I think people don't talk enough about. So let's dive right in. Let's kind of start and kind of at least frame the conversation with what are some of the current market conditions that you're seeing?
Yeah, I think what we need to do is start 5 years ago, look at the amount of investment we were receiving in InsurTech and PropTech and MortgageTech and FinTech back in 2020 and 2021, where this was really a boom era, right? And so we had the pandemic accelerating digital adoption across all of these industries. We had low rates and high demand in mortgage, especially, and not enough expert staff, which pushed us to become more of a digital industry at the time. And there was a ton of interest and money being pushed into that area 4 or 5 years ago. Now, you look at the time who was really prominent from a PropTech perspective, and names like Open Door or Zillow Offers, Knock, these all come to mind as big players at the time. You think about FinTech perspective, what was popular? Everyone needed a bridge loan, or we were doing these kind of buy now, pay later loans, right? So you could get the financing to make the cash offer on the house and then get the financing behind the scenes so that you won out against competitors. Stripe, Plaid, Chime, all of these companies were just pulling in investment. From an InsurTech perspective and from a MortgageTech perspective, the automation of underwriting, was perceived as something of extreme value because it was going to unleash opportunities to scale for all these companies. So companies like Lemonade and Hippo, who are still doing incredible in the insurance space, and then other companies in the mortgage space, like we saw what happened with UWM during that time, from a mortgage perspective, and they've just taken off. Rocket in a similar boat, and then others who maybe didn't meet the expectations of the time, like a Better.com. So I think when we talk about today's market, it's really important to start there.
I love how you frame that because I think so many people just want to talk about what's happening here and now, right? Yeah. Rates are kind of high depending on who you talk to. Volume is lower than people would like. And they kind of have that tunnel vision, but to really talk about what's taking place, talk to me about consolidation, talk to me about M&A activity. We have that backdrop of you had to know what happened 5 years ago. Yep. And then when you put that in the backdrop of what's going on today, talk to me where you see, is there going to be anticipated consolidation? Yes. What's happening with all these companies that took that investment money 5 years ago and aren't doing as well as anticipated?
Yeah, and at the time it was, we need a path to profitability. It's the 3Ds, disrupt, differentiate, and dominate, right? Like get these 3Ds, like come up with a path to profitability, take out your competitors, gain market share, then we'll change the business model. Well, here we are 5 days later, and it's time to change the business model. And it's kind of a ready or not moment. The time has passed. You may still not be profitable, but there is more of a push from the investors for you to become so. So today, the VCs and the PEs that I know that were making those investments are coming to the table with, how do we become profitable this year? What are we doing in 2025 to become profitable? And as you say, consolidation is a hot topic because if you can't IPO, what are you going to be doing? Right?
Right.
So it's a matter of, okay, we need to slow our cash burn. We need to get really tight on our differentiated products and our position within the market. We need to get profitable. And these VCs and PEs are looking at their portfolio going, where is their natural synergy that we can consolidate these groups? Because even if both are underperforming individually, we've invested in them. They're struggling because of the market, but they're really promising players.
Well, it's an interesting dynamic because, as you say, we've really got a drive towards profitability. Mm-hmm. But one of the comments I heard from another CEO just recently was very interesting when he said, Michael, we have to look at how do we get to profitability, but you can't cut your way to growth. So to your point of where do we find those synergies,
Yeah.
let's talk about some of the pain points then that companies are dealing with right now, and how do they find those synergies? How do they find those collaborations? Walk me through that, because I know you do this and you help out a ton of companies as you work in the M&A space. It's not just trying to get the deal done,
Right.
but then how do you work with them to get to this profitability and this synergy?
Yeah, I think strong unit economics is the first thing that comes to mind. And there's a lot that can be done with automation and needs to be done with automation um, within each of these organizations. There's a pressure on liquidity. So when we talk about pain points, I'm going to talk about IMBs now just for a moment. The IMB owners are feeling this pressure on liquidity. Their warehouse lines and the GSEs have the minimum net worth requirements. They've got liquidity requirements. Depending on whether or not they service, they've got additional requirements there. And so what we're seeing is now, some organizations are in their 10th or even 11th quarter of not being profitable. And maybe their balance sheet looks okay, but they're in this kind of pressure cooker situation where they are selling off strips of servicing now to be able to maintain these thresholds. And I think that creates an opportunity for our bigger servicers to acquire more and garner more market share, which is another area of potential consolidation on the servicing side.
Excellent points. And you bring such a fresh perspective to this, because I think while a lot of people know that these things are taking place behind the scenes, everyone's just looked at in the mortgage industry for a number of years of volume cures everything, right? If we
Right.
could just get more volume, if there was that refi boom that came, well, the refi boom didn't come last year. And according to most economists, the refi boom's probably not going to come again in 2025. So profitability is critical. Now let's talk a little bit about when you start diving into looking at companies that are good targets for M&A activity, whether it's the acquirer or the acquiree. What are some of the numbers and some of the profitability points that you would think a lot of companies know that they need to understand, but you're seeing that they don't really dig deep enough and don't fully understand those metrics? Walk me through a little bit of that.
I think one of the first areas to explore in an acquisition, if you are considering selling, is your tech debt. What does your tech stack look like? What is your tech debt? And what are the contract terms? Because whether you're doing a stock deal or an asset deal, there's going to be different obligations of the acquirer, right? But are you only paying for what your people are adopting and using? Are you leveraging technology that is helping you get forward? Are you buried under these contracts without any sort of recourse or ability to renegotiate those terms?
Oh, great point. And it's another one of those areas that not a lot of people think of, but a lot of these tech contracts are not just a 1 year, and they're not just pay subscription monthly as you go. It's a 2 year, a 4 year, a 5 year, an 8 year commitment. And to your point, there's a lot of then debt and requirement that has to be paid back for those tools. How do you analyze when you're going into these deals? What tech's being used? What kind of user adoption is there? What do you do when some of these companies, whether it's on the lending side, they have 2, 3, 4 LOSs, 2,
Right.
3 CRMs? Walk me through kind of that, challenge.
It's more common than you'd expect. And the story is so simple. We don't want to say no to our producers because we don't want them to leave, especially in the last couple of years. And we think, oh, it's an enterprise account, but it's not that. We'll swing it. We can't lose, right? Like a lot of leaders are playing from that position. A lot of owners are playing from that position of, I can't lose anyone, right? And so they've like taken this on, and we talk about, okay, what is the cost per user? What is the rate of return? And trying to do a simple analysis is not always easy, but a lot of these vendors do have reports right built into their systems that we can pull out, and that gives us a jumping off point to begin having a conversation. The second metric that I look at often is cost per employee, and I look at that for sales, operations, and corporate. If you're considering becoming acquired, I always say, run your business today like it's for sale, right? Like, and even if you're not considering
Right.
that, like, run your business like it's for sale. You let this stuff kind of accumulate and like, you know, become just like a colossal headache for you and your teams. You're gonna have a harder time positioning to sell if your outside market and your labor expense, or if your productivity per ops person is less than what it should be. You're gonna have issues there. So you got to keep a tight team that's working well and very productive.
Well, and I think that that tight team, like we said, you can't cut your way to growth,
Right.
but you really have to be strategic with where you investing. I know last year I spent a lot of time, invested a ton of time and energy into AI. So
Hmm.
I tested and used a lot of different AI tools. But this year, when I have to look and say, I got to challenge everything, some of those tools, while they were super cool, really didn't produce much ROI,
Yeah.
really weren't being leveraged and didn't have a lot of adoption. So I had to look at, could I cut some of those? And then a couple of that I found that I really used, how can I lean in and get much greater adoption and get much greater ROI out of that? So you're bringing up so many really good points. Let's talk about, a lot of people think, okay, you do the transaction's done, and now everything is just going to instantly, seamlessly come together. People are all going to work together. The cultures are going to mesh. Why is M&A integration management so critical? And what is that integration management really mean?
Yeah, I think it's kind of a funny analogy I've been working on. It's the idea of like, you can't reshape a pretzel after you bake it, right? And there's like this desire within the companies who are acquiring right now, there's this desire again of just like, well, we'll let them do whatever they want. Like, we're going to let them run autonomously. But then that's okay if that is truly your approach, but a lot of times it's not. It's just like a reactionary, like, at first they can do whatever they want and then they're going to fold into us. And so like, you can add salt to the pretzel after it's baked, right? Like, sprinkle in extra goodness, but you can't reshape the pretzel. It will break. So knowing, really having a clear path on what's non-negotiable versus where you're willing to be flexible, and having a cohesive message there with the seller, with the executive team on both sides of the house, is so important. And um, I've seen enough times where this is done, these acquisitions are done and managed by staff who's never done it before. A lot of what we're seeing in these consolidations are not serial acquirers, these are new consolidations. And so it's kind of like, if you think about the process of a loan, if you have a loan officer doing their first loan for the very first time, like, that's your deal team. And then they hand it off to a processor who's never processed a loan before. That's your ops team. How do you think that transaction is going to go? How's everyone going to feel at closing table? Is it going to get to the closing table, right?
Right.
So that's where M&A integration management comes in. If you have a project manager or a PMO office within your organization, that person is an excellent resource to the integrator that you bring in. But bringing in an outside integrator is having an expert there who can help identify, hey, these are the work streams we need to focus on because these are the targets of the deal. Your goals of the deal are X, Y, and Z. So this is where we're going to focus. So we're going to develop work streams around tech, around finance, around people. And that's really going to be what we do to secure that deal value.
I love it. And as you talk about those outside resources, talk to me about expertise as a service. I love that phrase. I've been a fractional for a number of years, but talk to me how expertise as a service is critical, not only in M&A, but really in the mortgage industry as we move forward, in FinTech as we move
Mhm.
forward, especially towards profitability.
Yeah, there are a lot of companies that are small to mid-size that don't need a full C-suite based on where they are today. Can maybe it doesn't make sense based on their size or what they're looking to do, but they do need an executive who's seen it and does it regularly, has these reps already that can help them with operational maturity and development of the team that they have, and help them really to zero in on, this is our vision, right? This is where we're aiming for. This is where we want to go. We have the board over here, but we need an executive within the team who can lend us thought leadership or who can lend us expertise, maybe 20 hours a week. Again, it might not be 40 hours a week.
Right.
And that's where expertise as a service comes in. I call it ease, right? Expertise as a service, ease. Whether that's a fractional or an interim executive position, or maybe it's advisory just for a specific group of folks within that org, there is a lot of flexibility there. And it's a great way for these companies to get ahead, I think.
So now let's talk about, you've created a new company, you have exciting announcements. Tell everyone what it is you're doing, the name of your company, and then let's get into how they can get a hold of you and how they can leverage this ease, this expertise as a service, and what you can bring to the table.
For sure. And I appreciate you teeing that up for me, because the company is called Telescope, and it's misspelled intentionally. It's TELOSCOPE. So the website is telescope.co. And you can reach me, jbrown@telescope.co as well. The company is centered on these things. It's centered on M&A integration management, like we talked about, as well as business management consulting. And the final branch of this is ease. So having a stable of executives that we can plug and play into different roles based on the needs of the companies. So what I'm looking to do is to help create an environment and an ecosystem where all of us, whether FinTech, PropTech, InsurTech, MortgageTech, or mortgage companies, are leading out in a way that we are able to build and design the future we really want. So we have a vision. Maybe it's a little bit unclear. So we together will look through the lens and clarify what your vision is, and then help you execute upon it.
Oh, I love it. And I'm a big proponent of that. You and I have had the opportunity to work on some projects. So I love the value that you're going to bring to the market. And I think for those executives that are out there looking at M&A activity, whether they're the acquirer or whether they're going to be acquired, there's more to it than just getting the signatures on the paper and saying the deal's done. Now a lot of the heavy lifting takes place. How do you create those synergies? How do you create the collaboration so that you can really drive profitability? Because to start our whole conversation, we talked about how do we get back, whether you're a vendor, whether you're a lender, whether you're on the property tech side, whatever it is, how do we get back to a form of profitability where these are sustainable business models? No matter of whether rates go up, whether rates go down, whether there's a refi boom or not, none of us have a crystal ball on all of that, but we can help restore profitability.
Absolutely.
What's the best way for people to get a hold of you? If they want to find out more, if they want to talk to you, besides going to the website, is there a number? Is there an email? Can they find you on LinkedIn?
I'm on LinkedIn. It's Julia Brown. There are many of us. There are many Julia Browns, though. So let me just share. There is a company site on LinkedIn. It is Telescope Advisors. And my individual email address is jbrown, like the color, at telescope.co. And it's TELOSCOPE.
Oh, I absolutely love it. I can't wait to see what you guys are doing. You're welcome back anytime. Julia, thank you so much for being a guest on this episode of the FinTech Hunting Podcast.
Thanks, Michael.